Silver is being capped, not by market forces, not by lack of demand, by design. This isn't speculation, it's structure. The price you see quoted every day isn't determined by the people buying physical metal. It's determined by contracts that represent metal that doesn't exist, traded by institutions that will never take delivery. And that system right now is showing stress fractures that suggest the suppression mechanism is approaching its operational limit. Understanding silver suppression starts with understanding what silver actually is. It's not just a precious metal. It's a dual-use asset, industrial and monetary, that makes it dangerous to the existing order in ways gold isn't. Gold can be dismissed as a relic, a barbarous remnant with no modern utility beyond central bank reserves and jewelry. Silver can't. It's in solar panels, electronics, medical equipment, defense systems, batteries, water purification. You can't run a modern economy without it, but you also can't ignore its history as money. For thousands of years, silver was currency, and that combination creates a problem for central banks that depend entirely on confidence in paper currency, and a surging silver price doesn't just challenge their narrative, it undermines it. The suppression mechanism is elegant in its simplicity. It runs through paper. Futures contracts on the COMEX, exchange-traded funds like SLV that issue shares backed by claims, not always by metal in allocated form, derivatives and swaps that create synthetic exposure without requiring anyone to hold the underlying asset. And all of this generates what appears to be supply, but it's not supply, it's leverage. And leverage, when applied to a market with finite physical availability, breaks the connection between price and reality. It creates a system where price discovery happens in a domain completely separate from the domain where actual metal changes hands. Here's how it works in practice. When you buy a silver futures contract, you're not buying silver, you're buying a promise to deliver silver at a future date. Most of those promises are never kept. They're rolled forward into the next contract month, settled in cash, or closed out before delivery ever becomes an issue. And that's the design. The system isn't built for delivery. It's built for speculation, hedging, and price discovery through leverage. And because the leverage is enormous, often exceeding 100 ounces of paper claims for every ounce of physical metal available for delivery, the paper market dwarfs the physical market in terms of trading volume. That means price gets set by traders managing risk on screens, not by refiners, miners, manufacturers, or investors handling actual metal. Central banks tolerate this structure because they benefit from it. A silver price that reflects true supply and demand dynamics would signal something they can't afford to signal right now. That fiat currency is losing the anchoring effect it's had since the end of Bretton Woods in 1971. That inflation isn't transitory, controllable, or even accurately measured. That the debt spiral they've created through decades of deficit spending and monetary expansion doesn't have an exit, that doesn't involve currency devaluation. Silver breaking higher doesn't just compete with gold as a store value, it challenges the entire interest rate structure, the bond market, the confidence game that keeps sovereign debt sustainable at current yields. So they don't intervene directly in silver markets. They don't need to. The paper structure does it for them. It absorbs demand, and it creates the illusion of abundant supply. And it keeps the price contained within a range that doesn't threaten the broader monetary system. This is why physical demand and paper price have decoupled so visibly over the past several years. You see it in premiums, you see it in delivery delays, you see it in the gap between what industrial buyers are quietly paying in private contracts and what the spot price says silver is worth on any given day. The spot price is fiction. It's the output of a leverage system where positioning matters. More than possession. Real buyers, the ones who need actual metal for manufacturing or long-term storage, don't set the price. They react to it. And when they can't get metal at the paper price, they pay more. But that premium doesn't feed back into the spot price. It just widens the spread. And the spread is a direct measure of system stress. The warning signs are mounting in ways that can't be ignored. If you're paying attention, premiums on physical silver coins and bars have been elevated for months, sometimes exceeding $4 or $5 per ounce over spot. Delivery windows are stretching beyond normal timelines. Vault inventories registered as available for delivery on the COMEX aren't growing the way they should given reported global supply figures. And in futures markets, there are moments, brief but telling, when near-term contracts trade at higher prices than contracts further out. That's called backwardation. It's rare in silver. It shouldn't happen in a market with abundant, accessible supply. But it does happen when the people holding paper contracts begin to realize that rolling their position into the next month might not guarantee they can actually get metal if they ever decide they want it. What happens when the paper leverage breaks isn't hypothetical, it's mechanical. If enough contract holders demand physical delivery at the same time, the system faces two choices: default on delivery obligations or reprice the metal high enough to make current holders willing to sell. Default destroys confidence in the entire exchange structure. It calls into question the integrity of commodity markets broadly. Repricing means the spot price has to rise sharply and suddenly until it clears the physical market at a level where supply and demand actually balance. And because silver's market is substantially smaller than gold's in terms of total above-ground investment stock and daily liquidity, the move would be faster and more violent. Silver doesn't move in modest percentage points when suppression breaks, it moves in multiples. That's what happened in 1980 when the Hunt brothers triggered a short squeeze. That's what happened in 2011 when post-financial crisis demand overwhelmed available supply, and both times the reset came after extended periods of suppression through paper instruments that couldn't sustain the structural imbalance. The suppression isn't permanent. It's a countdown. Every ounce of physical silver that leaves the COMEX system, every bar that moves from registered to eligible status, every coin purchased by an individual who intends to hold it outside the banking system is one less ounce available to settle the paper claims stacking up in the derivatives complex. Every premium spike is a visible crack in the pricing mechanism. Every backwardation event is a signal that the people inside the market, the traders and dealers who see order flow and vault movements, know something the published price isn't reflecting. The question isn't whether the system breaks. The question is what you're holding when it does. Silver is the only asset where demand rising doesn't guarantee price rising. That alone should tell you something is structurally wrong. This isn't a market behaving under normal supply and pipe demand mechanics. This is a market under active coordination. Silver has always been more than a commodity. For most of human history, it functioned as money. It settled debts. It moved between nations as a store of value that didn't depend on anyone's promise. That role didn't disappear because silver stopped being useful. It disappeared because paper currency systems required it to disappear. A monetary metal trading freely, reflecting real scarcity, becomes a measurement tool against fiat currencies, and measurements create accountability. That's why silver, despite industrial demand increasing and physical inventories tightening, remains systematically undervalued relative to its historical role in current fundamentals. The threat isn't that silver will replace the dollar. The threat is that silver's price, if allowed to move freely, would expose how much purchasing power fiat currency has lost. It would signal to markets that hard assets are being revalued against paper claims. That kind of signal can trigger capital flows out of bonds, out of cash positions, and into tangible stores of value. Central banks manage currency stability by managing perception. Silver moving parabolic disrupts that perception. It suggests the system is losing control. That's where the structure comes in. This isn't about a conspiracy in a back room. It's about incentive alignment across institutions that benefit from price stability in metals. Central banks need currency confidence. Bullion banks profit from facilitating trades and managing derivative exposure. Exchanges like COMEX and LBMA operate as venues where most silver trading happens on paper, not physical. These entities don't need to coordinate directly. They simply share the same structural interest in preventing silver from becoming a runaway asset. The tool used to suppress price isn't physical selling. It's leverage. 1 ounce of physical silver can support dozens, sometimes over 100 paper claims against it. These are futures contracts, options, unallocated accounts, ETF structures that don't require full backing. The effect is synthetic supply. When buyers enter the market, they're not just competing against real silver. They're competing against an artificially expanded supply of contractual promises to deliver silver. That flood of paper absorbs buying pressure and prevents price from reflecting physical scarcity. This is why price can drop even when mints are sold out and refiners are back-ordered. The price being quoted isn't the price of metal in a vault. It's the price of a contract referencing metal that may or may not exist in allocated form, and because most participants settle in cash, not metal, the system can function without ever being tested by mass delivery demands. Until it is, the suppression becomes most visible during breakout attempts. Silver starts moving higher on momentum or physical buying, and then during thin trading hours, large sell orders hit the market, prices gap down, margin requirements get raised on futures, forcing over-leveraged traders to liquidate. Liquidity dries up exactly when it's needed most. These aren't random market events. They're engineered responses designed to kill rallies before they gain psychological traction. Spoofing, The practice of placing large orders with no intention to execute has been documented and prosecuted in silver markets. It's not theory, it's case history. But something is shifting. Physical demand is no longer passively accepting paper prices. Retail buyers have been stacking silver at record levels. Coin and bar sales remain elevated even as prices stagnate. That's unusual. Normally, stagnant prices kill retail interest. Here, it's doing the opposite. Buyers are treating flat prices as opportunity, not warning. They're separating the paper market from the physical one in their own minds. Industrial demand is accelerating independently. Electric vehicles require silver for conductivity. Solar panels use it in photovoltaic cells. These aren't speculative purchases. These are consumption flows that remove metal from the market permanently. Every ounce used in a solar panel doesn't come back. It's gone. And as energy transitions scale globally, that consumption becomes structural, not cyclical. The gap between paper price and physical availability is widening. Dealers are quoting premiums above spot that didn't exist 5 years ago. Delivery delays are common. Allocated silver in vaults is being drawn down while paper markets show rising. Open interest. That's a dangerous imbalance. It means the system is becoming more leveraged even as the underlying physical base shrinks. If physical markets begin setting the price instead of paper markets, the recalibration would be severe. Price discovery would shift from exchanges trading contracts to refiners, mints, and dealers moving actual metal. Once that happens, the leverage unwinds. Paper claims either get redeemed or exposed as non-backed. Either outcome forces price higher, redemption creates delivery pressure, and exposure creates loss of confidence in the paper structure itself. This isn't about timing a squeeze, it's about recognizing that the current structure depends on physical holders staying passive and paper traders staying dominant. The moment that balance tips, the assumptions holding price down stop working. And when assumptions break in leveraged markets, the adjustment isn't gradual, it's rapid and disorderly. They can control the paper price, they can manage the contracts, they can flood the market with synthetic supply and suppress breakouts with coordinated sell pressure, but they cannot print physical silver. They cannot create new supply on demand, and they cannot stop industrial consumption or private accumulation from removing metal from the system faster than mining replaces it. And that's the structural reality. Everything else is just administration of a system that only works as long as no one calls the bluff. The question isn't whether the bluff gets called. The question is what happens when it does. Silver's price doesn't reflect its reality. Demand is rising across industrial sectors. Mining supply faces structural constraints, yet the price remains range-bound, capped, and unresponsive to fundamentals that would normally drive scarcity pricing. This isn't market inefficiency, it's market design. There are two silver markets operating simultaneously. One is the paper market, futures contracts, exchange-traded products, and over-the-counter swaps traded in volume that dwarfs annual mine production. The other is the physical market, coins, bars, allocated storage, and the industrial supply chain that feeds manufacturing. These two markets are connected by price, but separated by mechanics. The paper market sets the price, the physical market absorbs the consequences. Futures markets were built for price discovery, but they function through leverage. A single ounce of silver can back multiple contracts. Selling pressure doesn't require metal. It requires margin and positioning. When large participants enter short positions, they're not selling silver they own. They're selling contracts representing silver that may never be delivered. The price moves based on contract flow, not scarcity. This creates a dynamic where supply on paper can exceed supply in reality without immediate consequence. Central banks don't trade silver directly, but they control the variables that govern its behavior. Interest rates determine the opportunity cost of holding non-yielding assets. Currency strength affects commodity pricing across the board. Bond yields shift the attractiveness of hard assets relative to paper instruments. Liquidity injections influence speculative positioning in all risk-sensitive markets. Silver reacts to these signals because it sits at the intersection of monetary, metal, and industrial commodity. It moves when the system moves, not when its own fundamentals shift. The leverage embedded in futures trading allows selling pressure to persist regardless of physical tightness. Short positions accumulate without requiring inventory, contracts are rolled forward, delivery is deferred. The majority of participants never intend to take or make delivery. They're managing exposure, hedging risk, or speculating on direction. This structure enables price suppression even when the physical market tightens. The contract market and the metal market operate under different rules. But only one sets the price the world sees. Industrial demand for silver is accelerating. Solar panel production requires silver paste for conductivity. Artificial intelligence infrastructure depends on silver-bearing components. Electric vehicles use more silver per unit than traditional cars. These are not speculative use cases. They represent structural consumption growth tied to energy transition and technology deployment. Meanwhile, mining output has plateaued, ore grades are declining, new discoveries are rare, and existing mines face rising costs and regulatory pressure. The math suggests price should rise to equilibrate supply and demand, and it hasn't because the price isn't set by physical flows. A breakdown in the system would not announce itself gradually. It would emerge when physical demand exceeds the willingness or ability of the paper market to suppress price through contract positioning. COMEX inventory has tightened before without triggering a repricing event. But each cycle of drawdown increases the probability that a delivery demand surge cannot be met without dislocating the market, when premiums on physical silver separate significantly from spot price. It signals that buyers are willing to pay more for metal in hand than for contracts promising future delivery. That spread is a stress indicator if it widens beyond historical norms and sustains. The paper price loses credibility as a true market clearing level. The conditions for such an event are not predictable by date, but they are visible in data. Watch the premium structure on retail bullion and wholesale bars. Watch the gold-silver ratio for deviation from its long-term range. Watch the dollar index, because silver's dollar-denominated price responds to currency strength shifts. Watch real yields, which affect the relative cost of holding metal versus bonds. Watch LBMA and COMEX inventory levels, particularly the ratio of claims per ounce in registered stock. These are not signals to trade on reflex. They are variables that reveal whether the system is under tension. Silver isn't undervalued by accident. It's managed by a structure that favors contract liquidity over physical scarcity in price formation. That structure is held for years, but it requires continuous coordination and sufficient inventory to back the contracts that matter. And when it breaks, it won't move slowly. It will reprice to a level that reflects what the physical market was signaling all along. The question isn't whether that happens. The question is whether you're positioned before it does.